Well, Curtis, welcome to the podcast.
Yeah, thanks for having me, Rob. It's going to be a good time we have today.
I really think it will, and I'm so glad you're here because you and the credit team put around a note recently on commercial real estate. And it strikes me that over the past 4 years, if you think about the pandemic and the rise in interest rates, this is probably the single asset class that has faced the most headwinds over that period. And the other thing that sort of fascinates me is just, we think about markets as being quite efficient. And yet it's also interesting to see just how long it takes for certain themes to play out. Because I think you mentioned just yesterday that Blackstone's commercial real estate fund cut its dividends substantially as it's seeing an increase in defaults. So there is a lot to talk about when we think about commercial real estate. And I'm actually sure we could fill 4 hours easily on a podcast. But to start, can we zoom out? And can you provide just a general overview of the commercial real estate market and perhaps just what its evolution has been like over the past couple of years?
Yeah, thanks, Rob. So the overall size of the commercial real estate market, that would include kind of multifamily, office, retail, industrial properties. It's quite staggering. In 2023, Civilis, it's a British real estate firm, they estimated the total global property value of 50 trillion. And within that, US would obviously be the largest component. And so, while any estimate comes with a degree of uncertainty, to put this in perspective, the market value of the S&P 500, that's about 48 trillion. US Treasuries, that's about 28 trillion.
Okay, so a massive market.
Yeah, it's like really quite large. So we focus on credit, thankfully, so we can actually be a little more specific. We can give you a bit better number. And so the size of the commercial mortgage market in the US, according to the Mortgage Bankers Association, they put that at 4.5 trillion of commercial mortgages outstanding in the US.
Okay, so still pretty big.
Yeah, still big numbers. So given the size of the market, there's a lot of people involved. I've broken these into owners and lenders, and oftentimes you have entities acting as both. So an owner would be government, pension plans, insurance company, along with publicly traded REITs, private equity, ultra high net worth, and mom and pop investors. And then lenders, you would have some overlap. So government, pension plans, insurance companies, they appear there again. And then you also have your banks, your unsecured bond market, CMBS, and private credit. Then finally, owners, lenders, they lease the space themselves.
Okay, so lots of different players involved, both on the ownership side, on the lending side, presumably lots of intermediaries, investors. How about that evolution? So am I right in thinking about commercial real estate and just the past couple of years being pretty wild?
You're definitely spot on there. I mean, there's two major drivers over the past 5 years, in my view, and you alluded to them right at the start. So the first was the pandemic. You had the lockdowns and then the subsequent reopenings. And I would say this impacted commercial real estate subsectors like very differently. And that's dependent on city, industry, company-specific policies to return to work. And then secondly, you had the rise in interest rates. So if we rewind to July 2021, the US 10-year yield was about 1.5%. It's 4.2% today. And so as we saw interest rates rise, what are known as capitalization rates rise too. So a capitalization rate or a cap rate, that's an estimation of required return on investment. And so what you do is you take your property's cash flow and you divide it by your cap rate, and that derives your market value of the building. The higher the cap rate, lower value property. So while COVID had a very different impact on each different subsector, higher rates, it was a much more uniform impact across basic subsectors.
Okay. Can you talk a little bit more about those subsectors? So you mentioned multifamily, office, industrial, and retail. Can you just talk a little bit more about those? What's been going on there? Because as you said, different experience, and even within those, I imagine, depending on the quality of the real estate itself.
Yeah, so I'll start with the biggest, multifamily, and then I'll go through from biggest to smallest. So multifamily, I won't spend too much time on this. It's pretty stable. Demand's very stable. Data from U.S. Department Housing and Urban Development shows vacancy rates. They've declined from 7.6% to 6.6% from 2019 to 2023. Cap rates, however, CBRE data shows they've gone from 3.9% to 5.9% over that same time period. And that's really just reflective of change in interest rates.
These are the two primary metrics I think that we're going to be talking about, right? Is just vacancy rates and cap rates and how those have evolved.
Yeah, exactly. So your vacancy rate is what portion of your building is empty and what you're not earning rent of. And the cap rate we talked about a bit earlier. So for office, so COVID really impacted this differently. You had the work from home phenomena at the start of the pandemic, and then the gradual return to office. And that just has really weighed on demand. So your cap rate for a US office asset, that's from 4.2 to 6.5%, again, 2019 to 2023. Collier's data for vacancy rate, that's increased 11% all the way up to 17. So clearly there's some stress there. And in our view, it's largely a demand issue. The amount of people spending time in the offices is just lower relative to pre-pandemic.
I know we've got a couple more categories to go through, but just comparing those two, it seems to me like cap rates have gone up sort of in a commensurate way between both of those asset classes. The real difference is the vacancy rate, which I presume factors more into the forward-looking valuations for some of these properties.
Yeah, I would say that's fair. I mean, there'll be one sector, we'll wait only till we get there, that where cap rates might not have moved as much. But yeah, that's been a bit more uniform with the interest rate move. Whereas if you're looking forward, what building do you want to invest in? What building do you want to lend to? Is that vacancy rate is probably going to be pretty topical forward looking.
Okay, got it.
So then we go to retail. This subsector in the US, I mean, that's been struggling for a while pre-pandemic. Vacancy's been increasing, and that's largely due to online retailing. You just have more competition. But what happened kind of post-pandemic is actually a bit counterintuitive. So lockdown restrictions eased and people were free to return to spending. And what happened? You actually saw vacancies decline, went from about 6% to 5%. I think it was largely due you had a bunch of pent-up demand. People were eager to get back out there in person. So yeah, your retail vacancies declined. Cap rates, we saw a move to 6.6%. That's about 2% higher than pre-pandemic.
Okay, so that's retail. And that leaves us with industrial.
Yeah, so industrial, I'd say the pandemic impacted the sector differently as well. So you had physical stores shut and then online shopping proliferated. And that demand for warehouse space was very high because you had to support this e-commerce supply chain. And so we saw vacancy rates plummet. They went from 5% to 3.5%. That's from 2019 to 2022. What's interesting here is a lot of developers, they saw, well, look, hey, there's a ton of demand for industrial space. We should go build some.
I can attest for this in our neighborhood. Yes.
Yeah. Okay, you're seeing that too. So currently the vacancy rate's actually up at 5% again. And in contrast to office, where that rise in vacancy was just demand related, this has really just been the impact of supply, where there's more product coming online. And so what differentiates industrial, your cap rate only went from 4.7 to 5.4%. So that's a much smaller move than other subsectors.
Differences between the various entities. Again, interesting to see how the supply and demand dynamics can adjust. I am surprised by that retail piece. But I think, like you said, it's really the office space, which I think is pretty intuitive for many. For those watching this on YouTube, I'm working from home today, that would be the one where the impact was greatest.
Yeah, totally agree. Changes in behavior, that's most impacted the office sector. And I'd say the cap rates, that's negatively impacted valuations because they've increased. Where change in behavior, that's been mainly office sector.
Okay. Can we talk about valuations? And I was reading actually yesterday in the FT, there was an article, just somebody who had looked at if you had bought this basket of US REITs kind of across the board, right on the eve of the pandemic, what would your return have looked like through to today? And the answer is you'd be up kind of 16%, which on an annualized basis is quite a bit lower. So, call it reasonably flattish. Which is not what I would have thought based on some of the headwinds that you would have described. And so can we focus more on the valuation side? Like, have we seen write-downs? What have those looked like? And where we have seen them, whose loan book is, you talked about some of the lenders earlier, whose loan books are really exposed to that?
I'll start with loans and then we'll get into valuations. So for loan books, it's most significantly small banks are much more exposed than large banks in the US. So if you pull some data from the St. Louis Federal Reserve, the 25 largest commercial banks, they have about $860 billion in commercial real estate loans. Sounds like a big number, but that's only 6% of their collective assets. Whereas if you look at all the other banks outside of the top 25, they actually have $2 trillion in commercial real estate loans. And what's shocking, that's 30% of their assets. So that's an astonishing number, and that really is a significant exposure. That being said, we're not seeing significant charge-offs yet. Losses have been trending up, but they're low. Like your Q1 2024 charge-off ticked up to 23 basis points. That's up from 10 basis points year over year. For context, we're very far cry away from the highs of, call it 3% following the global financial crisis.
Okay, so 10 to 23, but not 300 basis points.
Yes, long ways away. Now, getting to your first question, just on kind of equity write-downs, I'd say it's a very broad spectrum. So the Canadian pensions, they released their annual results, and their real estate portfolios were down 15 to 5%. Those are really large, really diversified portfolios, both geographically and by asset class. On the other end of the spectrum, and this is what you might be seeing in kind of the media and the news, is you have something like single asset CMBS. So that market has shown several examples where an owner just walks away from the asset. And that's because the debt on that property is probably larger than the market value, or at least in that owner's opinion. So in that case, that would be a 100% write down on equity. And you're likely actually taking a hit as a lender as well. I can just give some context on cap rates. So Bank of America, they aggregate a ton of cap rates based on the entire REIT sector. And they show your average cap rate is about 6% now. That's up from 5% over the past 2 years.
I think that's the part that's like surprising to me. And maybe it's because I don't spend as much time in credit markets as you do or looking at the space. But, a move from 5 to 6% doesn't sound like much, just given the headwinds. And I'm just curious, like, in your view, is that appropriate, just given the fundamentals out there?
Yeah. So that's kind of a tough one. Like, the move in cap rates reflective fundamentals. I'd say like the market's actively trying to figure that out currently. So fundamentals are like they're definitely weaker. Cap rates are definitely higher, but is it enough? So the cap rate spread is one thing you can look at. So, and that's really shrunk over the past 3 years. So like a US 10-year treasury, that's increased about 3 percentage points from kind of bottom to top. Whereas your cap rates, as we acknowledged from Bank of America, that's only up 1%. So the incremental earnings relative to like a risk-free rate is much lower. For what it's worth, we've looked at several real estate companies over the past 6 months and thought the risk reward on the credit side was unattractive in all those scenarios.
All right. So that's something in and of itself. Looking forward, I mean, you're a credit analyst. You're looking at cash flows and maturities, debt profiles. In the commercial real estate space, what's coming up? I mean, we think about that a lot in terms of Canadians, in terms of the I think about it personally in terms of my own mortgage renewal. What does this look like in terms of the need to refinance for various issuers? Are they still able to borrow? Is there a big lumpy refinancing that's coming up? And what do those markets look like? Are they still financing these entities?
Yeah, so if we look at commercial mortgage loans, there's about 1.2 trillion in 2024 and 2025. That data is coming from the Mortgage Bankers Association. About 17% of that maturing stack is office product. And so we saw some data from Barclays, and they showed there's only been 2 single asset, single borrower New York office real estate deals this year, which leads us to believe there's not much refinancing activity going on.
Yeah, that seems shockingly low.
Yeah, and I would just say the ability to borrow in the office sector is tough. Like, you have rising vacancy, as we were talking about earlier. You have higher financing costs, and both those pressure your building values. If you think about it, these loans are typically made at 70% loan to value, meaning your loan is 70% of the building value. And so if your building value is falling, like, not only are lenders more hesitant to finance you, but if they do, you actually have to decrease the loan size because the value of your property has declined. And what's been really interesting, as refinancing asset has become really challenging, some owners just decide to sell their assets. And in the most challenged situations, sellers are actually resorting to vendor financing. And that means they're actually extending a loan to a buyer at below market rates. And that's just to incentivize them to buy that asset.
Wow, just to keep the music going, I guess.
Yeah, exactly. I'd say banks are also in a tough spot. And like we talked about before, it's particularly the smaller ones. Other pressures they have is like deposit costs are rising. You just have the risk of losing deposits. There's some proposed regulatory changes that are a concern. And then you already have a ton of that commercial real estate exposure at 30% assets. So all those things can restrict your bank's ability or willingness to lend more to the sector. So that was mainly just office, though, but there is a differentiation if we get into kind of different subsectors. And what we've seen is, even within different subsectors, what really matters is, I don't know if it's scale, location, or just quality of the asset portfolio.
Location.
Yeah, exactly. Like, you got a good tenant, a good location. Like, yeah, those are going to be refinanced. You're going to have to pay more. Like, your rate's going to be higher. Whereas if you have a more challenged asset in a less desirable market, that's going to be more challenged to refinance. And it's the same for different ownership types. Like the Canadian pensions, large diversified real estate owners, capital is available at a price. Smaller real estate companies, if you're in a specific niche or a single asset issuer, like, yeah, you're going to have a harder time borrowing in that case.
Curtis, you mentioned CMBS earlier, and I wonder if you can just walk us through what that looks like. Because to my earlier comment, it seems like a part of the market where there's a high degree of inefficiency and complexity. And so I'm almost imagining you as Margot Robbie in a bathtub, like in The Big Short. But can
Yeah,
you just take us
yeah,
through what that securitization market looks like and just some of the real quirks that you're seeing with respect to commercial real estate in that space?
yeah. Well, I might not do as good of a job as Margot did, but I'll give it my best shot. So let's just back up. So what is securitization? So essentially, it's credit risk being transferred from a lender looking to reduce exposure. That's typically banks to another party, which is typically bondholders. And so assets can be anything like car loans, credit card balances, high yield bonds. In this specific case, we're going to talk about commercial mortgages. So those assets packaged up and they're transferred to a purpose vehicle. The special purpose vehicle, they issue bonds. Typically, there's multiple tranches. You kind of have AAA at the top, equity at the bottom.
This is the Jenga stack from The Big Short. Yeah.
Yeah, that was the analogy they used. Yeah. And so when the SPV issue bonds, that pays for the purchase of the assets, and then you have that asset pool serves as collateral. And so when borrowers make payments, interest principal, there's a waterfall. So your most senior tranche AAA gets paid first, equity gets paid last. What's really interesting, and you've probably seen this a bit more in the media, is so there's the advent of single asset CMBS. So instead of having a diversified pool of, say, 100 buildings, you're actually only lending against one property. And this product type, it really boomed post-financial crisis in the easy money era. And now it actually accounts for 40% of the market.
Wow.
Yeah. So it's like quite prolific. But the concern is like, well, okay, well, what happens when like you have a single property as collateral and that underperforms?
Yeah, you don't have that diversification.
So I can give you a couple examples. So 1407 Broadway, that's an office building in New York, and it's facing foreclosure. I think the owner hasn't made a mortgage payment since July 2023. And what's remarkable, Fitch still continues to rate the most senior bond a AA minus. This was AAA originally. And just for those who are unaware, so Fitch reserves the AA category for borrowers with very high credit quality and debts with a low risk of default. Yet the bondholders on this 1407 Broadway, they're going to take a loss on this investment. Just down the street, we had Blackstone. They defaulted on a single asset CMBS, and the most senior tranche, that again was rated AAA, they only received about 75% of principal. So that's not consistent with what a AAA product is.
I want to make sure I heard you right. So in the first case, the 1407 Broadway, the payments have stopped to the owners of these CMBS.
Correct, yes.
And yet the rating, so basically they are in default effectively, and yet they still have extremely high quality credit ratings. Did I hear that right?
Yeah, you heard that 100% correct. It's puzzling to us, and it might be puzzling to the listeners too.
And so why might that be?
There's been more, call it single rated CMBS deals where there's only one rating agency versus a kind of diversified or 3 or 4 broad basket of rating agencies. So like you have some market participants, they're suggesting 100 billion of US CMBS is misrated. That's about 15% of the market.
And it's misrated.
Yeah, misrated. Yeah.
Okay.
And you're seeing that like in the market. So secondary market prices reflect that single asset CMBS. Like some are trading at steep discounts to par, which is basically the market saying this isn't AAA. And that's not just limited to U.S. real estate market. European investors and previously triple-rated CMBS, they're heading towards losses too.
Okay. So through a combination of higher cap rates, higher vacancy rates, particularly in some segments of the market, more difficulty refinancing going forward, definitely stress in commercial real estate, some of which is reflected in prices, some of which is not, and the same to be true with respect to credit ratings. So let's step back for a second. I want to get back to the work that you do, Curtis, as a credit analyst with our bond strategies. But just to summarize, higher vacancy rates, higher cap rates, more difficulty refinancing, and starting to see write-downs. So genuine stress in the commercial real estate market. And again, depending on the subsector. What does our exposure look like within the bond strategies, whether it's our Canadian bond strategy or our global credit opportunities strategy? What does our exposure look like in those two portfolios?
Yeah, so currently we don't have any direct exposure into either of our bond strategies. Neither fund owns CMBS or unsecured debt issued by real estate companies. I'd say that doesn't mean we don't look at it or monitor real estate market. In fact, the team does spend a fair amount of time on it. Firstly, that's just due to the sheer size and scope of the real estate financing market. What happens here can impact other sectors and markets where we're actively involved. And then secondly, we do have some indirect exposure. I can actually give you an example if you're interested. I can talk about some banks or insurance companies. They typically, as we talked about at the beginning, they lend or own real estate. So I can walk through an example on Sun Life if that'd be helpful.
Given the sheer scale of this market, it seems hard to believe that there wouldn't be any indirect exposure in some particular way. So yeah, would love to hear.
Exactly. So in the Canadian bond strategy, we own bonds issued by Sun Life Financial. It's a life insurance company, and like most life insurers, Sun Life both owns real estate assets directly. They also have a large mortgage book where it lends against real estate assets. So part of our credit review process for Sun Life, we look closely at what their real estate exposure is, and we try to assess how it can impact our bond investments. With some digging, we can learn that commercial mortgages and investment properties are about 8% and 6% of Sun Life's total investment portfolio, and that's a $173 billion portfolio. And now we kind of talked, like, if we're concerned about office, just perhaps, let's say, and worried about valuations there, we can dig a bit deeper. And their exposure to office assets is about 1.6 and 1.1% respectively. And so that's a level where we're comfortable with, given other factors like geographic, sector, and asset breakdown of their overall investment portfolio. We do the same analysis for other issuers we own, like Bank of America, Citigroup, Royal Bank, MetLife, et cetera. And that would assess the strategy's full exposure, whether that be the Canadian one or the global credit opportunities.
So to build on that, so okay, you're digging down to understand just the size of a particular exposure within their investment portfolio, but just more generally, what is the process, the credit process for evaluating real estate investments?
Happy to talk to that. So first, I just want to highlight the two main steps, and this would be for the entire investment process, not just real estate.
Okay.
So
any credit.
Any credit. We do kind of two main things in the intensive analysis portion, and that's your more credit rating, and that's more tied to valuation, and then you have margin of safety, and that's more tied to downside protection. So what we need to do is we need to complete our own analysis. That's looking at the business fundamentals, assessing management team, what's your leverage profile, and your covenants. And then we can assign an independent credit rating. And where it gets a little more exciting is you can take that credit rating and we can compare it to other bonds with the same rating and determine if your spread's attractive, unattractive. So that's kind of part one of intensive analysis. And then the second portion is margin of safety. And that's really about downside protection. So this analysis looks at what a creditor would claim when a company enters bankruptcy potentially. It's your worst case scenario. So first, you got to understand the liabilities of a company and the different priorities of claims. And then second, we have to try to assess the asset value, whether that's a liquidation value of assets where you just sell everything from the furniture to your operating assets, or it's a distressed M&A value where a competitor might say, hey, we can pick this up on the cheap. So once we get a sense of asset value and the priority claims liabilities, we can actually calculate an estimated margin of safety for different debt seniorities. And what would that show? It'd be like, hey, in this scenario, we think we're going to get 70 cents on the dollar, or this one, we're going to get 30 cents on the dollar.
Okay, so you mentioned that we don't actually own any of this in our portfolios, but have we looked at any investments that we've really kicked the tires on? And if so, would love to hear just what that's looked like.
Yeah, so I'll go through one for both global credit opportunities and Canadian bond portfolios. So one we analyzed for global was Aroundtown. That's a German office real estate company. It's currently rated BBB plus with a negative outlook by S&P. And so the review of the company, so this would be the more credit rating, the company revealed it's dealing with the impact of higher financing costs. It's got declining occupancy or rising vacancy, and the tenant credit quality was in challenge. So we concluded the fundamentals were not indicative of a company that was rated BBB plus on the more credit rating. On margin of safety, the key factor here was the existence of secured debt that would rank ahead of unsecured bondholders. This structural subordination suggested in a very worst case scenario, recovery on unsecured debt could be impaired. So when we combine that more credit rating with our margin of safety analysis, we just didn't feel like spreads were properly compensating us for the challenges faced by the issuer.
Okay, and here at home?
Yeah, so for the Canadian bond portfolio, we looked at a company recently called Granite Real Estate Investment Trust. It's currently rated Baa2 by Moody's and BBB high by DBRS. Just a quick overview. So Granite owns industrial real estate in US, Canada, and Europe. The assets are generally very high quality, but we've been more concerned about that weakening industry fundamentals, some of that supply we were talking about at the start of the podcast. Ultimately, our more credit rating, it landed on the same as Moody's. So same there. On margin of safety, so Granite, the capital structure is a bit simpler, so they only had unsecured debt, but we noted that was both bank debt and unsecured debentures. So we would invest in the debentures. However, we wanted to compare the covenant packages between the bank debt and public debt, just so we can fully understand where we actually sit on the capital structure relative to other lenders. And that was pretty key in our margin of safety analysis. I'd finally say, like with Granite, we decided not to invest. Spread seemed roughly fair value given our more credit rating and margin of safety review. A final part of our credit process is a mandatory check-in with the equity team. There may be times where they don't cover a specific issuer, but they will always have sort of insight and relevant information on the industry, peer group trends, et cetera. And that really enhances our analysis and actually improves our decision making.
I'm glad you brought that up because that was actually what I was going to ask next.
Really?
Granite REIT is certainly within the investment universe of our Canadian portfolio.
Yeah.
I could be wrong. We've owned it in the past on the equity side. So yeah, curious what those conversations look like.
Yeah, so we did own that in our Canadian bond portfolio in the past. We're not invested currently. So a clear competitive advantage at Moore is like the breadth and depth of our research team. And this really has the effect of expanding our credit team from 3 people to 40 plus. And so, yeah, on the Granite example, like we're in constant communication with the equity teams on Granite and on other names. So like a few weeks ago, myself and Mark Rutherford, he's a portfolio manager on our Canadian equity portfolio. We were going back and forth Granite because, like you said, it's held there. And so we spent the majority of that time discussing the industry, how high level of supply we're pressuring operating metrics. And we were really trying to get a sense of when supply could slow. I'd say we also have an extensive catalog of information just within the M42 database. Just for context, about 50% of the market value of the ICE Bank of America Global Corporate and High Yield Index. So that would be the index for the Global Credit Opportunities portfolio. So 50% of that has M42 notes on them.
So in our internal knowledge base, notes on these companies.
Yeah, exactly. And that's just a real considerable competitive advantage we have here at Moore.
Yeah, I can imagine that we talk a lot about cognitive diversity in terms of the makeup of our team, but this plays out here too, right? It's diversity of perspective coming at different parts of the capital structure. That's fascinating. Curtis, we've covered a lot of ground here, and I appreciate you taking us on this trip through commercial real estate. Any concluding thoughts? Things that we haven't covered so far that you feel are important to mention or that are useful in summary?
Yeah, I mean the real estate market, it's large, complex. The credit quality of borrowers really varies on a number of factors, whether that's your owners, your tenants, lease terms, location, asset type, leverage, vacancy rates, cap rates. Like that's just to name a few. The list could go on and on. With real estate, just like any potential investment, we want to review each issue and each issuer on a case-by-case basis. And that's following our thorough and rigorous process before committing investor capital. For us, that's our more credit rating and our margin of safety. And then after we determine them, it's deciding if our current spread's attractive enough to warrant investment. Right now, as we've touched on, we're not identifying any attractive real estate-related opportunities. That said, it's a market we're closely watching, both for direct investment opportunities and just the knock-on effects that real estate stresses can have on banks, insurance companies, other lenders, and investors in the real estate industry. I think I'll wrap it there. Appreciate you having me on the podcast today. Thanks, Rob.
Yeah, sounds like a great place to end. And again, appreciate your time, Curtis. And thanks to you and the credit team at Moore.